Have you ever wondered what an ETF is? Do you have questions like, is ETF like a mutual fund or an index fund? What are the charges? If yes, then this video is for you. We will compare and contrast ETFs, index funds, and actively managed mutual funds. We will compare them on many aspects like the charges, taxability, and many more. The first point is, what is ETF, index fund, and active fund? ETF means exchange traded fund, that is, a fund traded on the stock exchange. It's basically a mix of mutual fund and a stock and is traded only on the stock exchange, unlike a mutual fund. An index fund is a kind of mutual fund which only follows an index and hence is a passively managed investment. By active fund, we mean a mutual fund where there is a manager to select the portfolio for us and actively manage them for us. The second point of comparison is, what do they hold? An ETF, as we discussed, is a fund traded on the stock exchange. It can be an index fund which closely resembles an index. Say for example, Nippon India Nifty BEES, that is Nifty Benchmark Exchange Traded Scheme, has the same group of stocks in the same weightages as in the index Nifty. We have Nippon India Junior BEES that has the same constitution as Nifty Next 50. On the other hand, we have gold ETFs, which promise the returns provided by the price of gold. There are gold, currency, commodity, or even debt components like bonds in ETFs. There are many types of ETFs actually. So, an ETF can contain a portfolio of equities or debt-based instruments or gold, commodities. There are also international ETFs investing funds across the globe. Index funds can only be of two categories, equity and debt-based. On the other hand, mutual funds, the actively managed funds, can be equity or debt-based or can also be on gold, currency, commodity, real estate. There are also mutual funds investing funds internationally called fund of funds. I hope you are now clear what ETFs, index funds, and active mutual funds are based on. The third point of comparison is the charges, also known as the expense ratios. ETFs have lower charges compared to index funds. Index funds have lesser charges compared to active mutual funds. Let's compare an ETF and an index fund in the same investment category, that is, investment in Nifty. For example, Nippon India ETF called Nifty BEES has an expense ratio of 0.05% annually compared to an expense ratio of 0.2% for UTI Nifty Index Fund. Active funds charge 2 to 3% annually. The fourth point of discussion is the transaction costs. Since we discussed that ETFs have very low charges, if you think of buying more ETFs compared to index funds, then you are mistaken. That's because the difference in the charges for ETFs and index funds do not matter much. As a matter of fact, sometimes you may be better off with index funds. Because for buying or selling ETFs, you need to pay the transaction costs to your brokerage firm, much like trading stocks. So, If you take into account the brokerage costs, you may be better off with index funds. The fifth point of comparison is the liquidity. We can buy any ETF listed on the exchange. Technically, yes, we can buy, but it is not advisable to buy an ETF without looking at the liquidity. Meaning, we have to see the trading volume of the ETF you are looking to purchase. Just a quick demo here. Just go to the NSE website. Search for the ETF you want to purchase. For example, Nippon Nifty Bees ETF. The code is Nifty BEES. Just scroll down to look at the trading volume. The trading volume is more than 6 lakh shares. Let's take ICICI Prudential Nifty ETF. The trading volume is a bit lesser, about 67,000. Let's consider UTI Nifty ETF, not UTI Index Fund, but ETF. Because as we discussed, index funds are not available on the exchange, but ETFs are available in the exchange. The trading volume is just 486 shares, which means the liquidity is very low. In future, if you want to sell your ETFs, there may not be buyers. So, you will have to consider the liquidity of ETFs before investing in them. On the other hand, for index funds and other actively managed mutual funds, there is no problem of liquidity because you can redeem your units whenever you want. Of course, you may want to check the exit load and other conditions. These days, since mutual fund schemes are almost always open-ended, you can buy or redeem your units from the mutual fund houses as and how you wish. So what I mean to say is, with index funds and other actively managed mutual funds, there is no question about the liquidity. The sixth point of comparison is the minimum investment. Investors can buy as little as the price of one ETF. Much like a share, if you have money for buying one unit, you're good to go. But most index funds and other active mutual funds have a rule of minimum investment. Say for example, the minimum investment in UTI index fund is 500 rupees. Though the NAV of one unit is 105 rupees. This means you cannot buy just one unit of this index fund, unlike buying a single unit of ETF. The seventh point to compare is if you need a DEMAT account. You need to have a DEMAT account to trade ETFs because ETFs are also like stocks. On the other hand, you do not really need a DEMAT account to do transactions on index funds. I shall explain to you in a bit where and how you can buy the index funds. Purchase of actively managed funds also doesn't require that you hold a DEMAT account. This means that an average investor who doesn't trade stocks and still wants to have a taste of the stock market can buy an index fund or an actively managed mutual fund without having a DEMAT account. The eighth point of comparison is the taxability. Dividends from ETFs and mutual funds are usually added to the investor's income and taxed as per his or her slab rate. For dividends paid to investors in the excess of 5,000 rupees, 15% dividend distribution tax is levied on the investors. The taxability depends on whether the kind of investment is equity based or non-equity based. That is, whether your investment in ETFs or index funds or mutual funds is in the equity, that is the stock market, or non-equity like gold, debt or currency. For equity-based investments, be it ETF or index fund or mutual fund, short-term capital gains are considered as those gains on less than 1 year and taxed at 15%. Long-term capital gains are the gains from the sale of units after 1 year and taxed at 10% in excess of 1 lakh without indexation. For debt-based and gold instruments, be it in ETFs or index funds or mutual funds, short-term capital gains are considered for those units sold before 3 years, and such gains are added to the investor's annual income and taxed as per his or her income tax slab rate. For units sold after 3 years, the gain is considered long-term. Long-term capital gains in case of debt or gold instruments are taxed at 20% with indexation. So, there is no separate benefit of taxation just because you are investing in an ETF or index fund or mutual fund. The taxation actually depends on the basic investment you are in, whether it is an equity or non-equity based investment. If you invest in an ETF which is equity based, short-term capital gains of 15% and long-term capital gains, that is after 1 year, or at 10% above 1 lakh. Suppose you invest in debt-based mutual fund, short-term gains are added to your income and long-term gains, that is after 3 years, are taxed at 20%. But one thing to note is that if you invest in an actively managed mutual fund, the fund manager is usually aggressive, does a lot of shuffling of your portfolio depending on his discretion, and hence there is a lot of portfolio turnover. This frequent juggling of stocks in your portfolio results in a lot of short-term capital gain taxes and are all passed on to you as an investor. The ninth point of comparison is about where and how you can purchase or sell these funds. ETFs can be bought and sold only through your DEMAT account, very much like other stocks. Say for example, you search the name of the ETF that you would like to purchase and just proceed as you would, like buying stocks. Here is a quick demo. The purchase of index funds can be facilitated by your broker also, which means you can buy the index funds via your brokerage account, who in turn places the order with the AMC. The only advantage of buying through your brokerage account is that You have all your investments to look at it in one place, instead of browsing through the websites of various AMCs to look at your portfolio. But beware, not many brokerages offer the option of buying an index fund with the direct option. I hope you know the difference between direct and regular plans of mutual fund investing. This is a major setback to the intelligent investors who prefer buying the direct options of a mutual fund. The brokerage companies which offer regular plans of mutual funds to the investors often earn 1 to 2% as brokerage charges from the AMC, and hence the direct option of buying funds costs you less. So please be aware of the option while buying your funds. The purchase of actively managed mutual funds is very much like purchasing an index fund, because index fund is also a mutual fund. So as we discussed, we can purchase a mutual fund through an AMC or through your brokerage. Again, make sure you opt for the direct option instead of regular plan. The 10th point of comparison, or rather a similarity, is that all these options offer diversification. ETF in most of the cases follows an index, which in turn is a portfolio of different stocks in the index. Index fund also follows an index. An active mutual fund also has a collection of stocks spread over different categories. So all of them offer better diversification and reduced risk compared to holding a single stock. The 11th point of comparison is about the role of human emotions in such investments. Your investment in ETF is subject to your emotions. Let me tell you why. Though ETF is a passive form of investment, meaning it merely tracks an underlying index, commodity, etc., you can see the ETF units you currently hold in your portfolio, much like the other stocks you own. This means the price fluctuations are very obvious. In other words, the prices reflect the real-time market fluctuations and you might be prone to panic selling. The index funds, on the other hand, are managed separately in the mutual fund section of your trading account or at the website of the AMC. Also, the NAVs of the index fund units you are holding are not very dynamic and don't reflect the real-time market fluctuations. Investing in index funds is and should most likely be like invest and leave it, and therefore not subject to the everyday emotions. Talking about active mutual funds, there is definitely a bigger aspect of human element because after all, the fund is managed by a fund manager. There is definitely a chance of behavioral bias, irrational behavior, and emotional association with certain stocks of the portfolio. The 12th point is a very obvious one. In what units are they bought or sold? ETFs are held or traded as the number of shares. ETF has a price similar to a stock price. Index funds and active funds are held or traded as units. Each unit has a value called NAV or the net asset value. That's because they are mutual funds. The 13th point is also an obvious one, that is, when you can buy or sell these funds. ETFs, which also invest in index, can be traded throughout the day as they are listed on the stock exchanges, just like the stocks. So, if you would like to trade your investments real time in the stock market, like other stocks, then ETFs are the options for you. But personally, I myself do not like the concept of active trading with ETFs as it defeats the very concept of index investing, making you the victim of tyrannical cost compounding. Index funds can only be bought or redeemed at the price set at the end of the trading day. Say for example, you purchased UTI Nifty Index Fund at 1 pm. Your units will be allocated at the closing or end of the day NAV. That's because an index fund is also a mutual fund, except that its management style is passive. This difference of NAV is not a big concern for the long-term and serious investors. As such, I consider index investing synonymous to long-term investing and hence, I don't think we need to bother much about the fluctuations in the NAV for a difference of few hours. Active mutual funds are also purchased or redeemed at the price set at the end of the trading day. The 14th point is a quick comparison of the returns. ETFs should ideally give you the same returns as the benchmark index that it tracks, provided there is good enough liquidity for the ETF and you resist the temptation of frequent trading. Same is the case with index funds. Provided you resist the temptation of redeeming your units frequently. Active fund, on the other hand, aims to generate more returns than the benchmark index, but whether or not it can beat the index for longer periods is a point of concern. If you need an answer to this question, just look at the SPIVA report. Here is a quick snapshot. I hope I have given you enough information to understand the differences between ETFs, index funds, and actively managed mutual funds so that you can make wise and informed decisions. Have a good day.